Oil futures surge amid U.S. sanctions and trade optimism. Oil prices just won't quit, soaring for a third consecutive session and igniting debate among market watchers. What's pushing crude higher? A cocktail of factors keeps traders on their toes. Fresh worries that American sanctions could limit Russian oil in global markets. Excitement over budding trade agreements with heavyweights like the European Union and Japan, and the surprise boost from a robust jump in U.S. GDP for the second quarter. That's a lot of fuel for just one fire. But wait, there's a twist. Just as prices seemed set for liftoff, they wobbled slightly after the Federal Reserve opted to keep interest rates untouched, a classic curveball for energy investors. But here's where it gets controversial. Everyone's eyeing two massive wildcards that could shake up the oil narrative this week. First, the fast-approaching August 1st deadline looms large, potentially triggering new U.S. tariffs with international ripple effects. Then all bets are on the upcoming weekend when OPEC Plus leaders will huddle to set production quotas for September. Mizuho analyst Robert Yager notes that despite escalating tariffs and OPEC Plus pumping out more oil, the market's resilience has been impressive. Prices have bent but not broken. Case in point, yesterday, West Texas Intermediate WTI finished at $70 per barrel, up 1.1%, while Brent crude ticked up 1% to $73.24. But this is the part most people miss. Even a mammoth buildup in U.S. crude inventories, a 7.7 million barrel surge with distillate fuel stocks also rising, hasn't stopped oil futures from climbing. Normally, bigger stockpiles would spook traders, implying softer demand ahead. However, the looming geopolitical risks from U.S.-Russia tensions are overriding such concerns for now, driving prices higher. And let's not gloss over the biggest source of uncertainty. While deals with the EU and Japan support the bulls, a potential agreement with China hangs in the balance, leaving the future of oil markets up for grabs. Adding another layer, Forex.com analyst Razul Halal points out that technical indicators suggest oil prices are still trapped inside a 3-year declining trend, hinting at a ceiling even amid the current optimism. As of midday trading, WTI was up 0.7% at $69.71, with Brent crude gaining 0.6% to $72.96. So here's the million-dollar question. Are oil bulls underestimating the risk of a price cap? Or are the bears too quick to call for a turnaround? Where do you stand on the impact of soaring inventories versus hot-button geopolitical disputes? Jump into the comments. Should traders brace for another rally? Or is a reversal lurking just around the corner? Oil prices, Trump's tariff threats, and Russia's war impact. In a surprising turn of events, oil prices have seen a notable increase of 1% as investors closely monitor the implications of President Donald Trump's recent statements regarding Russia and his threats of tariffs. This uptick follows a significant rise of over 3% in the previous trading session as concerns about potential supply shortages come to the forefront. On Wednesday, Brent crude futures experienced a rise of 73 cents, equating to a 1.01% increase, bringing the price to $73.24 per barrel. Similarly, U.S. West Texas Intermediate crude saw a gain of 79 cents, or 1.14%, settling at $70. Interestingly, earlier in the day, both contracts had dipped nearly 1%, highlighting the volatility in the market. The catalyst for this price movement stems from Trump's announcement on Tuesday, where he indicated a more aggressive stance towards Russia. He stated that if Russia does not make significant progress in resolving the conflict in Ukraine within a tighter time frame of 10 to 12 days, He would impose secondary tariffs of 100% on countries that continue to trade with Russia. This is a shift from his previous 50-day deadline, signaling a more urgent approach to the situation. Additionally, Trump has already enacted a 25% tariff on goods imported from India, effective August 1st, and has hinted at unspecified penalties for nations purchasing Russian weapons and oil. The U.S. has also issued warnings to China, the largest importer of Russian oil, suggesting that it could face substantial tariffs if it persists in its purchases. Analysts from J.P. Morgan have noted that while it is unlikely China will adhere to U.S. sanctions, India appears more willing to comply, which could significantly impact Russian oil exports by as much as 2.3 million barrels per day. Dennis Kissler, a senior vice president of trading at BOK Financial, remarked, "Traders seem more focused on the tariffs related to Russia, and India's compliance is being viewed positively in terms of crude prices." In the backdrop of these developments, the U.S. Energy Information Administration reported a surprising increase in crude inventories, which rose by 7.7 million barrels. This figure starkly contrasts with analysts' expectations, which had predicted a draw of 1.3 million barrels. On the other hand, gasoline stocks saw a decline of 2.7 million barrels, diverging from the anticipated drop of 0.6 million barrels. Furthermore, distillate stockpiles, which encompass diesel and heating oil, increased by 3.6 million barrels, against expectations for a modest rise of 0.3 million barrels. Moreover, the U.S. economy showed signs of unexpected growth in the second quarter. The improvement was largely attributed to a decline in imports, while domestic demand grew at its slowest rate in 2.5 years. As the Federal Reserve prepares to announce its decision on interest rates, it is widely anticipated that rates will remain unchanged. This comes amidst ongoing pressure from President Trump, who has been advocating for a reduction in borrowing costs. But here's where it gets controversial. Are these tariff threats truly effective in influencing global oil markets? Or do they risk escalating tensions further? What do you think? Share your thoughts in the comments below. Oil prices drop. Trump's tariff threats U.S. stock surprises explained. In a world where oil prices can swing dramatically based on geopolitical events, recent developments have led to a notable decline in these prices. Investors are currently grappling with the implications of U.S. President Donald Trump's threats to impose tariffs as a means to expedite a resolution to the ongoing conflict in Ukraine. This situation is further complicated by an unexpected increase in U.S. crude oil inventories, which has also contributed to the downward pressure on prices. On July 31, 2025, Brent crude futures for September, which are set to expire soon, saw a decrease of 61 cents, translating to a 0.83% drop, bringing the price down to $72.63 per barrel by 13:26 GMT. Similarly, U.S. West Texas Intermediate crude for September fell by 68 cents, or 0.97%, settling at $69.32. This decline follows a day where both benchmarks had actually gained about 1%. Harry Chaligirian from Onyx Capital Group noted, "The market is preemptively reacting to President Trump's statements, but it's important to remember that his policy decisions can change rapidly if a deal is struck." He emphasized that the market is currently in a phase of reassessment, awaiting clearer signals regarding the situation. Trump has indicated that he plans to implement new tariffs on Russia, including a staggering 100% secondary tariff on its trading partners, unless there is significant progress in resolving the Ukraine conflict within a tight time frame of 10 to 12 days. This is a shift from an earlier deadline of 50 days, heightening the urgency of the situation. Additionally, the U.S. has issued warnings to China, the largest importer of Russian oil, suggesting that it could face substantial tariffs if it continues its purchases. In a related development, the U.S. Treasury Department announced new sanctions targeting over 115 individuals, entities, and vessels linked to Iran, intensifying the Trump administration's maximum pressure campaign following military actions against Iranian nuclear facilities in June. On the inventory front, the Energy Information Administration reported a surprising increase in U.S. crude oil stocks, which rose by 7.7 million barrels to a total of 426.7 million barrels for the week ending July 25th. This rise was largely attributed to a decrease in exports, while analysts had anticipated a decrease of 1.3 million barrels. Conversely, gasoline inventory saw a significant drop of 2.7 million barrels, falling to 228.4 million barrels, which was much larger than the expected reduction of 600,000 barrels. Toshitaka Tazawa, an analyst at Fujitomi Securities, remarked, "While the U.S. inventory data revealed an unexpected increase in crude stocks, the larger-than-anticipated draw in gasoline inventories supports the notion of robust demand during the driving season, resulting in a neutral effect on the oil market." As we navigate these complex dynamics, it's clear that the interplay between geopolitical tensions, market expectations, and inventory levels will continue to shape the oil landscape. What are your thoughts on the potential impact of Trump's tariff threats on global oil prices? Do you believe that the market is overreacting, or is there a valid concern about supply risks? Share your opinions in the comments.